So I'm Mark Jarvis, CEO of Giga Metals. And I don't have much time, so I'm just going to go through to a few key slides. We've got a very, very large, low-grade nickel and cobalt and sulfides deposit in north central British Columbia. We've recently done a PEA modeling building nameplate capacity of 37,000 tons per year of nickel with a 37-year mine life. So indeed a giant deposit. We think less than 25% of the entire deposit has been drilled off. So it's wide open. Compared to the other large low-grade sulfide nickel deposits in Canada, at least, they're all roughly the same. Some of the other deposits, such as Dumont, have a higher headline grade, but our recovered grades are very similar. And this is a very, very simple deposit. It's a young deposit geologically. So 99% of the nickel and cobalt are in pentlandite. So the processing circuit has to do one thing and one thing only: float pentlandite, reject everything else. And we get excellent recoveries for this deposit type. And the flow sheet is simplicity itself. So that's kind of our claim to fame with the large undeveloped sulfide deposits that are out there, all of which have poor economics to produce a concentrate for sale to smelters at the low end of nickel prices. That's why they're undeveloped. Our project is the simplest and therefore the lowest risk, technically. That's where we're located. Very large, low-grade resource. What I want to get to, one of the things we're looking at is to produce from our concentrate, we're looking at bolting on a step to produce MHP. So we would add a POX circuit, extra CapEx, extra OpEx. However, the payabilities for MHP are so much higher than you'd get from a smelter. Plus, MHP is the growing market for battery producers, whereas smelters are a declining market. Let's see here. So the other competition to produce battery metals, to produce nickel and cobalt for the battery business, is undeveloped HPAL projects. And so, of the large deposits of the world, most of them are HPAL. There's maybe 15 or 20 I can think of. There's probably projects I'm not aware of. But they all share the same thing. They all have economics that are terrible in Western terms at the low end of the nickel price range. So this chart here shows cumulative cash flow from our deposit based on our PEA base case price of $7.50 a pound nickel. Nickel's currently about $9 a pound. And so the green line is Turnagain. We spend $1.4 billion. Then we produce for a while. Then we spend another $500 million to double the capacity of the plant. And then we produce along for a total of 37 years. The dotted line is a typical successful HPAL project. We're not including Ravensthorpe, Goro, and Batavia and so forth, the big blow-ups. We're talking about the Ramus of the world. The Chinese are building these HPAL projects, typically $3 billion for a 35,000 ton per year capacity, and they're building them with internal rates of return of 1%, 2%, and 3%. They're building mines that Western companies would never build. But they are securing a long-term supply of critical battery metals at the operating cost. So they've got basically they're creating a long-term fixed price contract, which they won't be able to get from any producer by building mines using cheap capital. And so if the project takes 15 or 20 years to pay back its capital, so be it. They've got the material that they need. And we're at an interesting moment in time right now because the Western battery manufacturers are realizing, I think, that they're facing an existential crisis. Some of them may not be here 10 years from now. The Chinese are coming for them, and the Chinese are coming for them with their supply chains of raw materials intact. And Very few of the Western battery companies have got this figured out yet. BASF announced a joint venture with Nornickel to get nickel for a gigafactory in Finland. Panasonic announced a deal with BHP to get nickel sulfate from Australia for a gigafactory that Panasonic and Toyota are building in Japan as a joint venture. That's the start. You go to the producers first. But the Western battery companies are, in fact, looking at developers actively right now, I can tell you, and they should be. We've got something on, comparisons between an open pit mine and, laterite mining. Laterite mining, particularly in Papua New Guinea, Indonesia, that whole Coral Triangle area, they're strip mines. And so, as compared to an open pit hard rock mine, you're mining maybe 10 meters of soil, and you're ripping down tropical rainforests mile after mile after mile to do it. In many cases, you're then processing and dumping your tailings into the ocean. Plus, the carbon footprint is very high. So if you're thinking you're going to save the world by switching to electric, if you're using batteries derived from this source, you are not. And we've got a path, we think, to carbon neutrality for Scope 1 and 2 emissions at least. Sulfide deposits are just naturally lower in carbon intensity than laterite deposits, and particularly versus nickel pig iron. And in fact, ours, the way we modeled it in our PEA, we're at the very low end of the spectrum in terms of carbon intensity. We calculated our carbon intensity based on a diesel mining fleet at 2.24 to 1, 2.24 tons of CO2 equivalent per ton of nickel produced. If we could use an electric fleet, that gets us below 0.7 to 1. And if you include the results of sequestration of CO2 in our tailings, we can get that to 0. And this is something that we're actively doing research in with UBC, Dr. Greg Dipple, who has been studying passive sequestration of CO2 in silicate tailings piles for 16 years, Mount Keith in Australia, diabatic diamond mines in the Northwest Territories, so hot weather, cold weather, and so forth. And it's just very simple. The silicates absorb the CO2, convert to carbonates, and the CO2 is locked away forever. So it's a very interesting phenomenon that we're studying with great interest. And I think that's about as much time as I've got. If there's any questions. Okay, well, thank you very much.